When you're ready to start investing but feel that it might be too risky to put money into companies like Coca-Cola and Microsoft or Pepsi, whatever, what you can do is look into ETFs, which are a much safer alternative, and usually they've had steady growth over the years. So you go to the search bar, type in ETF, a little bubble will pop up, you click on that, and Robinhood will list all the ETFs that are available on the app. So here's what it is. An ETF is basically it takes a bunch of different companies, like 30, 40, 50, 100, 500 different companies, and puts them into one like bucket together, and then they sell you that bucket. So when you buy one share of an ETF, you're buying little pieces of like 100 different companies. That makes it a lot safer because if 10 of the companies are struggling, they're having a bad year, whatever it is, it won't affect the price of the ETF as much because the other 90 companies might be doing really well or just average. So it kind of just averages out. It takes a lot of the risk that comes along with buying one company. And when you look through here on the different ETFs, you can see they all have different prices, just like a stock. It basically works the exact same way as a single stock. You can just click on one and you can see it gives you a title of what this ETF tracks. This one, for example, tracks emerging markets. You can scroll all the way to the bottom and it gives you a little bit of about section on it. Tracks a market cap weighted index of emerging market stocks, including South Korea. So emerging market stocks are basically like countries like in Latin America and Africa and stuff like that. So this ETF will be a little bit riskier because of that, because you never know what's going to happen with those companies. And you can see it's got like a crazy up and down pattern over the last 5 years. So maybe you won't feel comfortable with that one and you can just keep looking, keep looking, keep looking. And then you see this one, for example, you're like, okay, it's a portfolio, S&P 500 growth. Go to the bottom. It tracks an index of primarily large cap growth stocks. So growth stocks are basically companies that are growing, like it says in the name. They're starting off small, they're getting bigger and all that stuff. So they tracks those. And as you can see, it's got more of a steady pattern of growth. Just looking at the last 5 years, it does plummet here, but overall it came back. Um, and a lot of ETFs will have the same pattern as this one because they track very similar companies. I mean, there's only so many companies to track, and they all end up with a similar pattern because of that. You can see the little plunge there, and it comes back. So there's some that are going to be different, but overall, you just keep looking here. Look at this same thing, pattern going up, little plunge, and then it comes back because they are all following, like I said, similar companies. So you can only have so many different patterns of companies in your bucket, and it makes it overall stable growth when it comes to ETF. So I recommend you look into these when you're starting out because you'll get that more consistent, stable growth.